Nobody sat us down and said, here's exactly what a bank looks at when you decide to get a home. Not in school, not from our parents, not from anybody. I'm Giselle from Home Qualifiers, and today I'm breaking down the entire mortgage process for you. We're gonna talk about what lenders look for. We're gonna talk about the small changes you can start making now to get closer to mortgage approval, how to prepare before you even apply, all of that good stuff. And the timeline does not matter. So whether you're planning to buy in the future, whether you're planning to buy 6 months, 12 months from now, all of this is gonna be useful information for you. So you're gonna wanna stick around the entire video. So let's get into it. When you understand what lenders look for early, you're gonna stop making those accidental mistakes that are hurting you. You're gonna stop opening the wrong account. You're gonna stop switching from jobs at the wrong time because that actually matters. And most importantly, you're gonna stop ignoring your credit. Understanding this information is gonna give you so much control, but it's also gonna save you so much money. So for example, two people can buy the exact same house. It can be in the exact same neighborhood, even on the same street. One person is going to pay so much more money than the other one. And I'm not just saying $20, $50, no, thousands of dollars. So a lot of money, all because of how they prepared for the process of buying a home. So let's start at the beginning, okay? Let's talk about what exactly is a mortgage loan. A mortgage loan is what helps you buy a home. So instead of paying the full price upfront, which most of us don't have sitting around, right? We don't have like $300,000 sitting around, $200,000 sitting around. A lender covers it first and you pay them back monthly over time with interest. Most mortgage loans are gonna run anywhere from 15 to 30 years. Your monthly payment is gonna include your loan, of course, interest, property taxes, and insurance. And here's what actually matters, okay? I need you to listen to this. It's not just about getting approved. It's about getting approved for the right loan with the right rate. So what are the loans I can get approved for? What numbers are we looking at? So there are 4 main loan types: FHA loan, VA loan, USDA loan, and a conventional loan. Starting with FHA loans, this is the most common loan that first-time home buyers get. You can qualify with a credit score as low as 580 with 3.5% down. An FHA loan is more flexible than most, but it does come with mortgage insurance built into it. So you are gonna pay a higher price. The next loan is a VA loan. So VA loan is only for active military or veterans. This is actually one of the most powerful benefits you have. No minimum score requirement, no down payment needed, no private insurance needed. So if you have it, use it. The next loan is a USDA loan. This is designed for homes in rural or suburban areas. There's no down payment required. However, there is income limits that do apply. And actually more people qualify than you think for this type of loan. Conventional loan is the standard loan. You'll typically need a 620 or higher to qualify for this loan. The down payment ranges anywhere from 3% to 20%. It just kind of depends on your lender. But the better credit you have, the better rate you will have. So each of these loan types do have different requirements, different benefits, and different paths to qualification. So you don't need to know which one you want right now, but it would be beneficial to know which one you're building towards. However, every lender, no matter what loan type you decide, is gonna evaluate 4 things when you apply. I like to call them the 4 pillars of mortgage approval. When all 4 pillars are solid, that means you're gonna get approved. When one of these areas is weak, it's gonna hold up the process. So here's each one. Pillar 1 is credit score. Credit score is gonna be your trust factor. This number is gonna tell a lender how reliable you have been with money you've been trusted with before. And this number is gonna actually determine 2 things. It's gonna determine whether you get approved, and it's gonna determine how much you're gonna pay. And I think the second part is what most people underestimate. They don't realize that credit is actually going to tell the lender how much to charge you in terms of interest rates. For example, let's say 2 people are going to take out a loan for a $300,000 home. One of them has a 620 credit score and the other has a 750 credit score. The person with a 750 credit score might lock in an interest rate of about 6.5%, while the person with the 620 credit score is probably going to lock in a rate of 7.5%. That 1% difference over a 30-year mortgage loan is going to be around $60,000 for the same house too. You know, nothing is changing other than your credit score. So 2 completely different outcomes just because of a number. So when I tell you improving your credit score by 30 points, 50 points, really makes a difference. So just to recap that information, the minimum score you want for each loan type is a 580 for an FHA loan, a 620 for a conventional loan, a USDA loan just kind of depends on your situation, and a VA loan has no minimum credit score required. So me personally, I always encourage for people to shoot for that 700. That is the sweet spot. That's where your options truly open up and you start seeing some savings coming in. And just so you guys know, Home Qualifiers can actually help you with that. So if you're looking to improve your credit score for only $50 a month, Home Qualifiers is gonna get that credit working for you. So just so you know, if you guys want more information, I'll go ahead and leave it in the description below. Pillar number 2, income and employment. The second thing that a lender is gonna wanna see is stability, right? They're not gonna give you this huge loan and not have any stability from your end. They're gonna need proof that your income is actually gonna be able to support this loan that you're asking for. So they're gonna ask for W-2 forms, they're gonna ask for pay stubs, and usually 2 years of tax returns. So with that, the question that I get all the time is, okay, do I need perfect work history? What do I need in terms of my employment? You just need to show consistency. A lot of people have the misconception that you need to work for the same employer for 2 years, but that's actually not true. All you need to do is work in the same field of employment for 2 years. So not necessarily the same company, but it needs to be the same industry. So jumping careers right before you apply for a home is going to be a red flag. If you're self-employed, documentation is going to look a little bit different. So that's why I mentioned that they're probably going to ask for 2 years of those tax returns. Pillar number 3, DTI or debt to income ratio. So what is DTI? What is debt to income ratio? I think this is one of the most misunderstood pillars, and honestly the one that catches people off guard the most. Your debt to income ratio is the percentage of your monthly gross income that goes towards paying off existing debt. Your car payment, your student debt, all of that stuff. So here's how to figure out yours. The first thing you're gonna do is add up all of your monthly debt payments. So your car payment, any credit card payments, anything like that. You're gonna go ahead and divide that by your gross monthly income before taxes, and that percentage is actually gonna be your DTI. So for example, if you bring $5,000 of monthly income, but you have to pay $1,500 of debt every single month, your DTI is 30%. So that's pretty solid. Most of the time, lenders are going to want your DTI to be under 43%. Some programs are going to allow up to 50%. It just kind of depends. But that sweet spot is going to be having your DTI under 43%. Here's what gets people off guard sometimes during the application process. People come in with phenomenal credit scores, ready to just kind of sign off on that loan, and you get denied because of your DTI. The reason is because your DTI is going to show lenders whether you can afford to add more debt on top of what you have already. So know your numbers and calculate it before you even meet with a lender. The last pillar is pillar 4, which is down payment and savings. Lenders want to see that you are ready and financially responsible for homeownership. That means you need to have money for 3 things: your down payment, your closing cost, and just a cushion left over for any extra expenses that you may come across. So now let's talk numbers, okay? I know that we have that misconception implanted in our brain that we need at least 20% of our home costs in down payment, and that's actually not true. Just like I mentioned before, an FHA loan, you only need 3.5% down. Conventional loan, you can get away with just 3% down. So there's tons of options. VA loan, USDA loan, that's 0% of down payment. So it's important to do your research and to understand that that myth of 20% down, it was a long time ago. Something that does blindside people is closing cost. So that's typically going to be another 2 to 5% of that loan amount on top of your down payment. So just be prepared for that. The path to homeownership is not about being perfect in one area. It's about having balance across all 4 pillars. And if you made it this far into the video, now you know the 4 pillars of mortgage approval. Pillar number 1, your credit score is going to tell lenders you can be trusted. Pillar number 2, income and employment, is going to prove you can handle responsibility. Pillar number 3, debt to income, is going to show you live within your means and are not overextending yourself. And last but not least, pillar number 4, your savings are going to show that you're ready. When those 4 pillars align, the whole process is just going to become so much easier for you. Lenders are going to say yes more easily. You're going to qualify for better programs. You're going to qualify for better rates. And I want to leave you with this. There is small changes you can start making now that is gonna make this process a lot easier. So even paying 1 or 2 credit cards down is gonna go ahead and help you get that DTI down. Or removing inaccurate items from your credit report is actually gonna get your credit score to go up. Adding $200 a month to a savings account is actually gonna help that down payment build up. Every intentional move you make from now is gonna cause a reaction. Even the small ones are gonna help you get closer to your keys. And if you want a tool that's gonna help you keep track of all of this, dispute letters, credit repair, savings, all of that good stuff, Home Qualifiers is on your side. So if this video helped you, please do me a favor and subscribe. I will be posting more videos like this on a weekly basis. And drop a comment below right now which pillar it is you need to work on the most right now, and I'm gonna go ahead and read all of them. If this video helped you, please subscribe. I will be back every single week with content like this about stuff that, we were never taught. So I will see you next week.